Well, we are in conversation with the top team of UBS from the 10th India conference of UBS. Gautam, this year's been about what a lot of people are calling A, B, and C, auto, banks, and cement and capital goods. You've spoken about the banks, but what about autos and capital goods? Do you think the kind of rally that we have seen is justifiable, and can that sustain, or would you now have slightly cautious view on these sectors?
So you have to be more selective, definitely, because both the sectors are very, very diverse. So in autos, the stance we have is definitely be bullish on four-wheelers and specifically Maruti, because there is upside surprise potential in terms of demand coming in, and that's the output we got from our evidence lab survey we did a couple of months back, that even despite the earnings upgrades we have seen, there remains surprise potential ahead. And that's why we continue to like Maruti. While we still remain cautious on two-wheelers, one, because there's little upside potential in terms of volume surprise, and secondly, the operating leverage is also limited in that sector. So we continue to prefer the four-wheeler space and continue to be underweight at two-wheelers. Similarly, in this capital goods space, the space is very, very diverse, and you have to be much more selective. The other top-down view which we have is the investment cycle recovery is happening as we speak, but will take time to play out. Investment cycle anywhere in the world, and including in India where we have more local specific issues, doesn't happen in a year or two. It's a 3 to 4 year process, and we still, I would say, in second year in the process. Where last year we had some of the macro policy corrections taking place. This year we have sentiment coming in. By next year, hopefully, we'll see the surplus capacities getting absorbed. And then we have a proper investment cycle recovery. So you have to be more selective and tactical in that space rather than just going whole hog.
Okay. Well, before the break, we were speaking about the decline in commodity and oil prices. Geoffrey, Dennis, what is the UBS assumption on commodity prices next year? The sense in the markets is that the Reserve Bank governor will hold out in December 2nd, primarily because no one knows whether the fall in commodity, especially crude, is for good. Will it sustain over the next many months?
Yes, I mean, that's a very good quote. Nobody knows. We don't know where the oil price is going. Our belief is that the long-term oil price is still around $100 for Brent. So obviously that's considerably higher than we are today. And at some point, I think we're going to move back in that general direction. But I think given what's going on in the global economy right now, in particular, of course, the continuing strength of the dollar, it's quite likely that commodity prices are going to remain on the soft side, I think, in the very short term, unless, of course, you get a major contraction of supply. And clearly what's happened in the oil market in particular recently is you've seen some significant boost to supply from the United States, from Saudi Arabia. It's really played a very big role in pulling oil prices down. So I think the supply side is very important also. But for now, I think one has to assume the benefits India gets, for example, from lower oil and other commodity prices is probably going to stay in place for a while, even if longer term down the road, we eventually have a pickup in the oil price. I think you have to assume soft commodity prices and the benefits of that, certainly in the short term.
Well, Edward, what's the UBS view on US rate hikes? When does it come? Mid-2015, late 2015? And if that happens, will it only be bond investments that will go for a toss? Will flows into Indian equities also shudder?
Well, I'll let Jeff answer the question on the flows into equities. But the view we have on US rates is that the first federal funds rate hike will come in the second quarter, and that federal funds will move up over 1% by the end of 2015 calendar, and move up again towards 3% by the end of 2016 calendar. Bond yields, we think, will also creep higher. I think an interesting thing comparison with India is that we still think Indian bond yields can come down over that time frame as US bond yields go up, because the gap between inflation, the inflation risk premium in India, can drop relative to that in the US. Recall, rates in the US are going up partly because the US authorities are going to be successful at getting inflation risks up.
My line's gone down.
All right. There is an audio problem there, but we will get back to our guest from UBS in just a second. In the meanwhile, the markets have moved just a wee bit into the green. Still flat terrain, actually,
Yes,
for the Sensex and
the mid-cap index is running away now.
Mid-cap
Lata.
index,
It's up almost 1% now. And take a look at some of the top traded counters. You have Sri Lanka, that's up 3.5%. Well, we got connection back with the UBS team. Gautam, this 9600 Nifty target, what's the timeline for this, and what's the key risk to your market call now?
So the timeline is December 15. And the premise behind that is not any significant re-rating, but just the earnings momentum coming back, given the mild recovery we are forecasting. And that should suffice to drive the 15% plus earnings growth forecast, which are out there in the street. So we are positive on that. The risk to that, again, I would argue is largely local. So if you see the government taking wrong steps, so that's the only risk I can think of, which remains in place. I'm less worried about the global environment in terms of rate hikes in the U.S. Impacting Indian equity markets, as long as the government continues to take the right steps towards getting the economy back on track.
Geoffrey, what's your call? What's the key risk? Because so far we haven't had any meaningful correction in this market. The best was 5% correction, and that too was lapped up. Is there a risk of a significant correction in India?
I mean, I think Gautam's, said it the right way. It's being driven, of course, primarily by the reform agenda, by the likely pickup in the economy, the good performance by the corporate sector. I mean, honestly, the 15 to 16% EPS growth that we're looking for in India is just well above what you're going to see in other markets in EM. And so I think it's any faltering in that which could give you a pullback in India, and could, of course, give you a period of underperformance. For EM overall, there is no doubt in my mind that an aggressive move by the Fed combined with a stronger dollar is going to create a significant headwind for the emerging markets were that to happen in 2015, and then I think that is something that we have to keep an eye on. If there's any doubt about the timing of the Fed's first move, and indeed if there's any flattening off of the dollar's rising trend for a period of time, that's going to be very bullish for flows into the emerging markets. So I think for the asset classes as a whole, the big risk in 2015 will come from liquidity getting sucked out of the markets by aggressive Federal Reserve action, and that's something that we will have to monitor very, very carefully. But as Gautam says, that doesn't have to be an isolated particular risk for India overall, but it's certainly a risk for emerging markets as an asset class.
Oh yes, and it's certainly a risk the Reserve Bank governor keeps reminding us about. Geoffrey Dennis, Edward Teather, Gautam Chhaochharia, it was a pleasure speaking with you. Thank you very much for joining us on CNBC TV 18.